The good-looking gentleman in the screen is Nate. Nate, to make sure that you turn off your sound so it doesn't reverberate through your things. Before we get started, I have a little YouTube video about my company that I want to play for you, and then we'll get right into it. Started Aero Marine Tax Professionals a couple of decades ago. At that point, most people who were buying airplanes hired an aviation attorney who billed them $600 to $1,000 an hour, and I realized I could deliver the work faster with a guarantee, and I charge less. And so we did that, and in infinitesimally small amount of time, we're the biggest company that there is that does this. We've done over 1,400 cases. We've never failed even one. And at any time, we're monitoring between 100 and 150 active audits with the state of California. That's who we are.
As the Executive Director of Aero Marine Tax Professionals, the staff here is 100% client focused. We want 100% satisfaction from all of our clients. We are available 24/7 for them. Our ultimate goal is to get their exemption and have them so happy that they're referring us to other people that they know. So if you are interested in becoming a part of our team, give me a call. Their mission is to make sure that we have a happy client.
The reason that we're doing this is because there's a gap between the knowledge of how to do things, whether it's law, whether it's procedural, whether it's maintenance, that it actually is all available, just that most people don't know where to get it. So I'm trying, our organization, I want to become the hub so that the entire industry can get all of its resources through me. That is my ultimate goal for doing all this, because it's important for them to for us to make it easy for them to get the information that they need. So that's the reason why I'm kicking up everything that we're doing, from the YouTube videos to the articles that I write, to the things that are going on with my website, to all of the stuff, is because it's vital. It's extremely vital that they have good information from a trusted source. I'm not someone who's trying to sell them an airplane. I'm trying to assist the sales process in the aviation market. When I first started this business, I did a complete market survey with a very large marketing firm. The number one button in this industry is saving money. We've got this information from you guys, okay? And that is what we do, and we're very successful at it. We've done over 1,400 cases and never failed one. At any given moment, we are monitoring between 100 and 150 audits with the state of California. So join us, become part of our family, and you can be part of our winning success rate. We'd love to help you. So here it is, the most important pieces of information, how the Trump tax plan is affecting business aviation. There's some, what I think are really good issues here. The guys, Nate and John from Aero Law, are a couple of the most brightest aviation attorneys I've ever known. Nate, you got the floor.
Thank you, Tom. Thank you, everyone, for joining today. I know this is a really hot topic in the industry right now. This was a very significant tax bill, the Tax Cuts and Jobs Act of 2017. It's going to affect a lot of the economy, but there's lots of provisions in here that will affect business aviation in particular, and very positively, we hope. So thank you for your attendance today, and we'll get started. Just a little bit of background on John and myself. We're with a firm called Aero Law Group. We are headquartered in Bellevue, Washington, in the Seattle area office. The background you see behind me is Campus Drive in Newport Beach. My office is here at ACI Jet in Southern California. We are a transactional law firm that does nothing but transactional work for end users of business aircraft, and we have 8 attorneys that do nothing but transactional work with aircraft. So we're very pleased to be with you here today. There's a number of aspects to the tax bill that we'll discuss today, but the first one I want to start off with is maybe something that hasn't been discussed very much in the industry. It's the change to federal excise taxes on aviation. Some of you may have heard, it characterized that, well, this is a giveaway to business aviation. They're reducing taxes on business aviation, but nothing further could be from the truth. I want to point out, start by trying to make a distinction between FAA rules and IRS federal excise tax rules. You may have heard that, well, it's excise taxes. We only have to worry about excise taxes if we're operating under Part 135, and if we're Part 91, we don't have to worry about federal excise taxes. Well, the answer is that the FAA and the IRS speak completely different languages. So you don't want to mix up your silos. You have your FAA silo over here and your IRS excise tax silo over there. So they don't speak the same language. The FAA talks in terms of Part 91 versus Part 95, Part 135. The IRS talks about commercial versus non-commercial. The FAA talks about operational control of a particular flight. The IRS talks about possession, command, and control of a particular flight. The FAA talks about common carriage, holding yourself out to the public, where the IRS doesn't talk about holding yourself out to the public. It just talks about transportation of persons or property for compensation or hire. The FAA talks about reimbursements among corporate groups, parent subsidiary organizations, but the IRS has a different exemption for affiliated group. So it's the same federal government, but they have different laws and different agencies administering them. So you really can't confuse these things. So just a quick recap on the taxes that apply to business aviation. There is a fuel tax on non-commercial aviation. For jet fuel, that is a tax of 21.9 cents per gallon. So whenever you pull a Jet A powered aircraft up to the pump, the price is going to include 21.9 cents per gallon fuel tax. However, if the aircraft is in the business of transporting persons or property for hire, the fuel tax goes down to 4.4 cents. You have to file for a refund of that 17.5 cent per gallon tax. But that it's a lower tax if you're carrying passengers or property for hire. In the case of fractional aircraft, such as the FlexJet NetJets program, there's a 14.1 cents per gallon tax for those operators that have Part 91K capability. So that's the fuel tax. What is implicated in the tax bill is the 7.5% federal excise tax on taxable transportation. So that's the tax that is paid to charter carriers if you're chartering 135, but it also applies in some certain Part 91 circumstances. That last bullet point at the bottom on the slide is that it's either or. You don't pay both the 7.5% excise tax and the 21.9 cents fuel tax. You pay one or the other. So that's the thing to bear in mind. As I said in a previous slide, the question of whether federal excise tax applies doesn't depend on whether it's a Part 91 versus Part 135 flight. It turns on the FAA test of possession, command, and control. Is the party providing the aircraft to the party paying for the aircraft? Does the party providing the aircraft have possession, command, and control? If yes, then you owe the 7.5% excise tax. If not, then you don't owe it. So the red flag that you have to be aware of is whenever there are payments going from one person to another in exchange for use of the aircraft, and the entity providing the aircraft retains indicia of ownership or control other than just holding title to the aircraft, you have a potential issue with federal excise tax. Now, a few years ago, in 2012, there was a Chief Counsel memorandum which kind of started this whole thing in the tax bill that asked the question, well, what about Part 91 management agreements where an aircraft owner hires a management company, a professional outside third-party management company, to operate the aircraft on its behalf? Are those type of arrangements taxable? And based on the reasoning in that memo and how they interpreted previous IRS rulings, it really looked like the IRS was about to impose 7.5% FET on third-party management relationships. So this was a big deal in the industry. There were multi-million-dollar assessments imposed by the IRS against various management companies, even though we were only talking about Part 91 management services for their clients. So this really turned the aircraft management industry into turmoil. There was a lot of lobbying by NBAA to stop that, and I think at some point the examinations and assessments on Part 91 flights were suspended, but we've been kind of living in limbo the last few years on this issue. But the good news is the Tax Cuts and Jobs Act addressed this issue specifically. Section 138.22 of the Act added a new subsection E to Section 4261 of the Internal Revenue Code, and it says that there is no 7.5% FET on amounts paid by an aircraft owner for aircraft management services that are related to maintenance and support of the aircraft owner's own aircraft or flights on the aircraft owner's own aircraft. So that looks like a pretty good relief there, pretty clear statement. There's some corner cases that we'll get into here in a couple minutes, but it's a big sigh of relief for the industry that that the IRS can't anymore try to impose excise tax on Part 91 operations. So this is something that's a very good thing for the industry. However, that third bullet point there indicates that there's kind of a hold card for the IRS in that if there are relationships that aren't exempted by this exception, they can still impose a pro rata excise tax on the amounts that don't qualify for the exemption. So basically, the Tax Cuts and Jobs Act defines non-taxable aviation services as scheduling flights on the aircraft, flight planning, weather forecasting, providing insurance for the aircraft, maintenance, storage, and fueling of the aircraft. And here's a really key point, is that providing and training pilots, the management company providing and training pilots and providing them to the aircraft owner for flights on the aircraft owner's own aircraft, those types of services are specifically not subject to FET. And that was the big issue with the IRS memo from 2012, is that they focused very, very hard on the fact that the third-party management company was providing pilots. And if the third-party management company was providing pilots, then the presumption was that the situation was excise taxable. So this is a really key part of the legislation here. So providing pilots, getting your pilots from a third-party management company is no longer in and of itself an excise taxable situation. Another part of the exemption says that the third-party management company can establish an operating manual or safety standards for operating flights on the owner's aircraft. And then this is kind of key language from the legislation. Non-taxable management services include other necessary services to support flights operated by the aircraft owner. And that language I highlighted there in yellow, operated by, is probably key, or maybe key, as the service and the courts start addressing what the legislation means. It's pretty clear, I think, but you might have some people trying to say, well, even though it's trying to get this exemption to apply to situations where the aircraft isn't operated by the aircraft owner. So flights that are Part 135, flights for the aircraft owner are probably going to continue to be regular FET taxable. And time-showing flights, that kind of thing, where operational control is retained by the lessor. So we're probably just talking about an exemption related to Part 91 flights there. One of the wrinkles that will have to be addressed is, so the legislation talks about an exemption for an aircraft owner. And thankfully, the legislation also treats an aircraft lessee as an aircraft owner, except in the situation where you have a lease of 31 days or less from a provider of aircraft management services. So again, this is only one sentence in the legislation, so there's some things to unpack from it. The definition of aircraft management services is not the same as the definition of items that are specifically exempt from FET. So it may turn out that any lease of 31 days or less may not be exempt if there's any kind of services being provided with respect to the aircraft. So you might lose the safe harbor exemption if you have flight planning or hangar or insurance or other services coming with the aircraft, and it's a lease of 31 days or less. The other thing to think about here is lots of people do hourly leases, lots of people do leases that are month to month, or terminable on 10 days notice or something like that. So do those kinds of leases, are they less than 31 days? They might be in effect for months or years, but are they, as a matter of this exemption, one of the 31 days or less leases that aren't subject to the safe harbor? So there are some things that need to be worked out, I think, in this exemption there. Any questions on the exemption for FET? I know it's been a fair amount of time on it, but it's something that I think has been overlooked as to its importance. And I think overall it'll be a very good thing for the industry, bring some certainty, but there are some wrinkles that still need to be worked out. Tom, did you have a question?
I realized at the beginning I had forgot to tell people that they could ask questions using the text mechanism that's built into their link. And at this point, there are no questions. So what I would suggest that you do is continue with your presentation. And if a question does come through, we'll pause and go back to it.
Absolutely. Well, let's dive into the income tax side of things here. Everybody wants to ask the question, we get this question a lot, can I deduct my aircraft expenses for a private aircraft? And the question is, well, just setting up an LLC, to own the aircraft and buy it in there doesn't mean that you have a deductible use of the aircraft. You have to show that you're using the aircraft in a business to support your business. And not only that, you have to show that it's an ordinary necessary business expense. And what that means is you have to show both that traveling by air is required, but another thing you have to be prepared to show is that is your need only met by private aircraft. And this is kind of the threshold question that the IRS likes to trip folks up on examinations. They might buy a business aircraft, but if their business doesn't really take them out of their immediate area, or they're only operating on schedules and to cities where there's no need for private air travel, if you're not prepared to make the argument why the aircraft helps your business and makes you more productive and allows you to do schedules that you couldn't do in the airlines, you're going to have some trouble. So we put together kind of a checklist here for arguments that we see people make with the IRS in terms of not risking cancellation of a particular flight on the airlines, if there's a strike or weather or something like that. If we're traveling to remote airports that don't have regular commercial airline service or more than 1 or 2 flights a day, that's an argument that you can't spend multiple days traveling to that particular location. It's a big time saver. Working on the flight in privacy is another big argument. You can't do that on the airlines with everybody, 180 of your closest friends looking over your shoulder. doing trips to multiple locations and doing itineraries in multiple cities in one day that you just can't do on the airlines. That's another reason. Depending on how many people are traveling and the availability of seats, it may be more cost effective for a particular trip to be run on a private aircraft. Last minute changes to travel itinerary. Commercial airline service is flights run very, very full compared to what they did, 20, 30 years ago. So if you've got a group of people and you've got to make last minute changes, the flight you want may be sold out. So you may not, if you have last minute changes and know you're going to have them, you might only be able to make your mission work with private aircraft. So there's lots of arguments you can make to show that the aircraft is a important business tool for you. And you need to do that. That's your threshold question before you can start to think about depreciating an aircraft. So when we talk about depreciation, for this presentation, we're talking about tax depreciation. But there's three different types of depreciation that we need to think about and distinguish and keep straight in our heads. One is what we call market depreciation, and that's the actual loss of value of the aircraft in the market over time. You bought the aircraft for $15 million, but say 10 years from now, the market is only going to be able to let you sell it for $5 million. That decrease in value over time is market depreciation. A completely separate concept is book depreciation, which is a conservative accounting estimate of based on the cost value of the aircraft and an assumed depreciation value and an assumed residual value, or which may be zero, and that goes on the financial records on the balance sheet, and the depreciation gets charged on the earnings statement every quarter and every year. And so that's what the accountants, conservatively estimate what the aircraft is worth on their books for that particular time. It's a completely separate concept. So what we're talking about is tax depreciation, which is intended to reflect the loss in value or wearing out of the property over time. And the one which is interesting based on the recent law change, we're trying to match tax deductions to the income that the asset produces. So as I'll mention here, we've got 100% depreciation available in the first year of aircraft that are placed into service. So we've kind of given up, not just for aircraft, but lots of capital assets that people are placing into service in the economy. We've given up on matching the deduction for the investment to income over time. So tax depreciation is even more unrelated to reality than it used to be. It used to be that, as I'll show in the coming slides, that we had 5 or 7 year depreciation schedules. Now we potentially can have depreciation 100% right up in the first year. So these are a couple of charts here that show typical estimates of market depreciation by types of aircraft over time, kind of based on a very long view of an experience of what values have actually done for jet turboprop and piston aircraft over time. Here's a chart we put together a few years ago for a 2002 Falcon 900EX, and you can see right there the blue lines show the bubble in market depreciation. There was an extreme bull market for business aircraft in the early 2000s, peaking in around 2007, 2008. But the Aircraft Blue Book, Conklin and DeDecker, the Conklin and DeDecker estimate that long-term trending is still down. So there's a very big gap between what we'd expect and what reality turned out to be. And then this slide just shows the difference between market depreciation, book depreciation, and tax depreciation over that same time. So they're all three very, very different concepts. So as I mentioned, the intent of depreciation is to match your tax deductions for assets with the income that the assets produce. We've got a couple classes of aircraft, depending on whether they're used in business or whether they're used primarily for charter use. I see we have a question here. I'm trying to turn on some notifications so I can make sure that I get interrupted.
We have a couple. First one is if you could touch on the depreciation recapture rule if an aircraft is converted to personal use. And once you get a chance to answer that, I have another question.
Right, absolutely. So recapture, someone pretty savvy on depreciation already. So if you place an aircraft in service and you take depreciation, um, the cost of the aircraft minus the depreciation equals what they call your adjusted basis in the aircraft. And your adjusted basis in the aircraft goes down over time and may eventually reach zero when you fully depreciate the aircraft. But the market value of that aircraft is not going to be zero. So the difference between the market value and the adjusted basis is if you go to sell the aircraft, that difference is the amount that you would pay ordinary income tax on, and that's what they call recapture.
Thank you for that answer, Nate. But I think the question specifically was asking if you start depreciating a business use aircraft, then convert it to personal use. Let's say after the old rules of being a Part 91 aircraft, being able to depreciate it in 5 years. What happens if you convert it to personal use in year 2 or 3?
Yeah, absolutely. So if you're not disposing of the aircraft, I think the rule is that that you don't have a realization event in that circumstance. Now, if you to get accelerated depreciation and the 100% bonus depreciation that we'll talk about, you have to use the aircraft more than 50% in business for that 5 or 7 year period entirely. If you stop using it in business for that period of time, then you're going to have recapture. So the regulation, it depends on when you do it and the percentages and everything. So what the service comes back and says is, okay, we're going to recapture the bonus depreciation you took or the accelerated depreciation you took, and treat it as if you had not been eligible for accelerated or bonus, but you were only eligible for straight line depreciation, and we're going to recapture when you convert it to personal use the excess depreciation that you took over your over the straight line depreciation. So that's assuming that the aircraft is on your personal tax return. It's not inside a partnership or S corp or C corp, and you do that type of conversion.
Okay.
So if you're actually converting it to personal use, it falls below 50%. Well, actually, I think it might apply to an entity as well, but that's the thing you have to really watch out for. So that's a good question. But yeah, I was trying to explain what recapture is for some folks that might not know about it.
All right, I have another question. Are you allowed to select a depreciation schedule instead of just using the straight 100% in 2018?
Yes, you are. So you can elect not to take the 100% bonus depreciation and just take regular maker's depreciation. But if you do that, you have to do that for all property in a particular asset class, whether it's 5-year property or 6-year property. You can't just do it, say, for the aircraft. Well, I can't use the 100% bonus, so I'm not going to take it. If there's other property that you placed into service that year that happens to be in the same asset class, you have to elect it for that as well. I don't think that happens very often, but just a caution there. You can elect out of bonus depreciation and just take regular accelerated depreciation. You can also make an election to take straight line depreciation instead of accelerated depreciation. You can do that too.
Thank you. One more. This person said he's new to the U.S. market and affiliated with a Part 135 company. He wants to know, do we charge tax? And I'm presuming this is an excise tax question. Do we charge tax, and to what levels for aircraft management and charter services?
Well, if you make a proper distinction in your agreement with the management company between your own Part 91 flights and Part 135 flights that are operated by the public, you shouldn't have to pay excise tax on your management services. But you've got to fall within that new safe harbor and make sure that the services that are being provided, fall within those categories that they're accepting. But I think you would probably also get an argument from the service that if it really looked like you were chartering your own aircraft from the management company, I think you could still get that argument. If they were operating at Part 135, I don't think that exemption applies. I think it applies to aircraft only that you assume control with, that you operate yourself, that the management company doesn't operate for you. So there's lots of things that could go into that question. We'd have to look at the particular tax, particular facts and circumstances, but you can do it if you plan properly, I think.
Okay, that's the last of the questions I have so far, so I'll stop interrupting.
I'm going to go ahead. Oops, I skipped too far ahead. Hold on. So I'm on slide 26 here now. So let's talk about specifically bonus depreciation under the Tax Cuts and Jobs Act. So what they did was amend section 168K of the code, and 168K has been with us for, gosh, 15 years now, or maybe more. They introduced it with when they wanted to do bonus depreciation in the wake of 9/11 attacks and that recession. It was expanded in 2003, expanded again maybe in 2005, and then 2008. So we've had it for many years, that section 168K. So what the Jobs Act did was amend 168K to provide 100% bonus depreciation in the first year, and that's good for property placed in service through the end of 2022. So that's another almost 5 years from now. So that's a really good thing. The previous bonus depreciation only applied to new property that the taxpayer was the original user of, but it now applies to used property. So kind of the tax playing field has sort of been leveled between new aircraft and used aircraft. Maybe manufacturers aren't so happy about that when they're trying to sell new aircraft, but it also improves, the market for their used aircraft, which is, good for manufacturers too, I think. One thing you have to bear in mind is that you can't, to get 100% depreciation, you can't have previously used property. So you can't, if you own an aircraft, you can't go out and sell it to somebody and then immediately buy it back to get 100% depreciation that year. If you previously used the property, you can't get bonus depreciation. So they built in an anti-abuse and anti-churning rule into the legislation. This is probably the most important one to consider, is that to qualify for 100% bonus depreciation or 168K, you have to remain eligible for maker's depreciation for the entire depreciable depreciation schedule. What does that mean? That means if the aircraft would ordinarily be depreciated as under the 5-year maker's accelerated schedule, you have to have at least 50% qualified business use for every year of that depreciation schedule. If it's 7-year property, if it's primarily used in charter, you have to use the aircraft at least 50% of the time in qualifying business use. So you've got to remain eligible for maker's depreciation during that whole period. If you fall below that 50%, the IRS is going to come back and say, okay, that bonus depreciation 100% you took, we're going to recapture a portion of that. We're also going to recapture, a portion of the maker's depreciation, and we're going to switch you over to straight line. So even though you haven't sold the aircraft, and maybe you don't have the dollars, to pay the recapture, they're going to charge you recapture because you're no longer for the maker's depreciation. So that's a very important thing to remember. 100%, it's not like you take it and you're done. You could have a recapture event if you fall below the percentage of qualified business use. Other thing to point out is that bonus depreciation is not available on the California income tax return. It's only a federal tax return benefit for right now. I don't think California is going to be doing that, and with the loss of deductibility of state income taxes and property taxes, California is even talking about raising corporate and other taxes to make up for that loss of deduction. So no bonus depreciation on your California return. So I mentioned if you are no longer eligible for makers during any year of the normal makers depreciation schedule, whether 5 or 7 years, you get recapture, and you have to switch to straight line ADS depreciation. There's a couple other ways to fall out of makers eligibility. One is to lease it to a tax exempt entity. I think any leasing account counts. It's not that it's primarily leased to a tax exempt entity, but I had this come up recently. I was shocked. We did come across a situation where there was a lease to a tax exempt entity, and so we had to switch from accelerated to straight line depreciation. The other thing to watch out for is if you're primarily using the aircraft outside the United States. Property primarily based and used outside the United States is not eligible for makers depreciation and therefore not eligible for bonus depreciation 100%. There may be a rule that you could qualify under if your aircraft is U.S. registered and travels to and from the U.S. regularly, but you'll have to address that with your particular facts and circumstances. One thing to keep in mind here is that the bonus depreciation went into effect for property placed in service beginning the end of September of 2017, September 28th, in fact. Legislation says after September 27th, so effectively September 28th. But the tax rate deductions didn't go into effect until January 1st. So you've got this last quarter of 2017 where bonus depreciation might be worth a lot to people. If they happen to place an aircraft in service during the fourth quarter of 2017, they get 100% depreciation to offset their higher tax rates. So it's kind of a windfall for those taxpayers. Another question?
Yeah, we have some questions. One of them, and I think you just answered it, but I want to make sure. It says, I purchased an aircraft in August of 2017 and placed it in service in October 2017. Will I be considered to have used the aircraft previously?
That's a good question. I'm not sure I want to do that off the top of my head without looking at the specific text of the legislation. I think it is based on placed in service date, but I think you need to be really careful on that. And placed in service is it's a term of art. If you have to be careful not to try to make an aggressive position there.
Okay.
Yeah, so I think that's probably all I want to say. If you want to give me a call and go into that in more detail, that'd be fine.
For the person that asked that specific question, you should be able to get Nate's phone number off the listing that we have. If not, you can email me direct, and I'll put the two of you in communication. I have three more questions for you, Nate.
Yeah, I think it's placed on service, but if you acquired it and then placed it in service, there's some gap rules, and that actually happened to a client of mine that bought it, like their aircraft a week before September 28th, and so missed it by that much, as Get Smart would say.
Yep.
What's the next question?
If you have more than one LLC, can you sell an aircraft at its depreciated value between LLCs without paying recapture?
That's a good question. I want to say maybe. Because I'm looking at the legislation here. It doesn't look like it says when they amended it to. There is some incorporation of Section 179 in the legislation, and 179 has some restrictions to aircraft acquired from related parties and that kind of thing. I think they would probably. I think that would be problematic, but I haven't looked at it in that detail yet. So I'd say Danger Will Robinson right now. and we'd have to look really close at that. I don't think so. I don't think that would be allowed, but that's just preliminary answer.
All right, maybe what we should do is on all these specific questions is try to take them off the air, because I don't want this event to go much longer than the original 55 to 60 minutes I promised to people, unless they don't mind staying on. Just give me your feelings about that. Anyone tell me how you feel about it going too long. But I will ask this. I still have two more questions. Is 135 charter use of your aircraft by definition business use, regardless of who the charter customer is? Thus, even if the charter customer happens to be an owner of the entity that owns the aircraft?
Depending on the facts and circumstances, you may have, a hard time making that argument. If it be otherwise 100% personal use aircraft, but instead you just chartered it through a charter company, and then you're in the charter business, I don't think that kind of relationship would be, overall respected. I have a hard time seeing how that would be respected.
Okay.
So that.
Last question so far. Can you talk a little bit more about capital improvements and 100% bonus depreciation?
Yeah. For items that you would otherwise have to depreciate, such as replacing the engines and that kind of thing. I thought about this a little bit because I guess it depends on what you're upgrading and installing. You might have an engine overhaul that's very expensive, and you may have to capitalize it and depreciate it. But you may not be able to argue that you were you weren't previously a user of that engine. So, like I said before, if you acquired a capital asset, to get 100%, you cannot have previously used that property. But if you send an engine out for overhaul, you previously were using that engine, so I'm not sure that you could take 100% depreciation on that. It depends, I think, on what you're installing. If it's like a whole new set of boxes, avionics for your cockpit that you never used before, maybe bonus depreciation would apply, no problem. But if you're talking about an overhaul or refurbishment of property you already owned, it might be a closer question. So yeah, good question.
Okay, go back to your presentation.
All right, well, we're on to slide 29, and this is a handy chart for when do we get bonus depreciation. Now we have 100% bonus depreciation from now through the end of 2022 for aircraft placed in service until then. We could still get 100% bonus depreciation in 2023 for quote unquote certain aircraft and transportation property if you have a binding purchase agreement entered into before the end of 2022. So that's what that dashed line means. But then in years 2023, 24, 25, 26, the 100% goes down in 20 percentage point chunks, down to 80%, then 60%, then 40%, then 20%, and then bonus depreciation no longer exists in 2027. The dotted lines, and I think I explained this on the next slide here, you can have an extended placed in service date and still get the previous 100% or whatever bonus depreciation percentage. If you're a certain aircraft, it has to be more expensive aircraft. Virtually all jets and turboprop aircraft will qualify for that. Or if you're transportation property, property used in the trader business of transporting persons or property, it's not clear if that's aircraft predominantly used in charter. We're not exactly clear on that. But if you have transportation property, only the part of the cost of that property, the adjusted basis of that cost of that property attributable to manufacturer before January 1st of the extension year is eligible for bonus depreciation. That's kind of a wrinkle there. So we're many years out from those issues, but I did want to point those out. the IRS has a very specific idea of what a written binding contract is. So when you get, 4.5 years from now, and you're thinking about signing a contract to get bonus depreciation in 2023, 100%, got to make sure that your written binding contract meets IRS requirements, and that's listed in that slide. No, we're running out of time, and so I'm going to move a little bit quickly through these slides here. Here's a slide that shows, compares 100%.
For a second. Let me interrupt you for a second. The consensus of the people who voted was to take as much time as you want to get as much of this presentation you've done. So don't try to get it. Don't slow it down. And also,
Sure. Okay.
So everyone knows, the reason we as an organization want the whole thing covered is that this will be available on video on our website. So we want the whole subject there. So don't skip anything.
Absolutely. No.
And we'll make sure everyone who's on this gets a link to see the whole thing.
Great. So here's a chart comparing 100% depreciation versus 5-year makers depreciation. You don't get more than the cost of the aircraft, $3 million, to deduct on your tax return. You just get it accelerated into the present. So we basically compare on this slide 100% bonus depreciation versus no bonus depreciation at the previous 35% tax rate. And if you compare it, it's not millions and millions of dollars that bonus depreciation saves you. You have to consider the net present value of bonus depreciation. And for 100% bonus versus 5-year makers depreciation, it's only about 2.6% of the value of the aircraft. Now, one of the other things that the tax bill does was, for corporate taxpayers, the tax rate has gone down from 35% to 21%. So what has happened here? The value of bonus depreciation has gone down significantly. So under a 21% tax rate, 100% bonus is only worth about 1.6% of the value of the aircraft rather than 2.6. So it's ironic. I mean, everybody's going to have more money in their pockets, if your corporate tax rates are going down, or that's the theory. There are some other limitations on corporate deductibility of interest and other things that might have an impact. But with tax rates going down, the value of depreciation, bonus depreciation, goes down itself. So it yet to be seen how much bonus depreciation is going to make a difference compared to the change in the tax rates. I wanted to point a few things on bonus depreciation about how the value of it might be degraded if there's personal entertainment use of the aircraft. So I'll get into this in a future slide. The bonus depreciation might be limited by personal entertainment use. If you're not paying any taxes this year in year one, or your tax rate is lower, you have to take that into account to figure out, well, do I want 100% this year? Is it really worth buying this year, or do I not have a big tax bill anyway this year to offset? One thing you always have to keep in mind of is if you're leasing the aircraft or chartering out to third parties, you may run into the passive activity loss limitations, so you might not get to take all that depreciation in the first year if you're using it in a passive activity and can't offset that passive loss with other passive income. And I mentioned previously, if your business use is under 50% in future tax years, you end up recapturing that. 100% bonus depreciation isn't going to be worth millions of dollars to the typical taxpayer. It's more likely a small percentage of the purchase price. It's not going to be worth as much if you're a corporate taxpayer paying only 21% tax. So it's a nice benefit, but it's not earth-shaking, huge government subsidy for business aircraft type benefit. So be circumspect in figuring out what the benefits of bonus depreciation are for your particular circumstance. This thing I was thinking of, it used to be that bonus depreciation was kind of a red flag on tax returns because it was such a large deduction, and it ended up creating, losses that might be carried back or carried forward, and might be a huge audit exposure red flag. But now everybody's getting it. It's not just for aircraft, but any property under 20 years in class life is going to get subject to bonus depreciation. So I'm not sure how the IRS they can't audit everybody that's taking bonus depreciation because everybody's taking it. So the audit exposure of bonus depreciation might go down. One thing I wanted to point out on personal entertainment use, and this applies if your aircraft is on the tax return of a S Corp or LLC taxed as a partnership. Depreciation is one of the items that gets disallowed based on the percentage of entertainment use of the aircraft by specified individuals. And those specified individuals are your CEO, CFO, those types, and any person that's a 10% or greater shareholder. So entertainment use of the aircraft by those people or their guests results in loss of depreciation deductions. However, the regulations that the IRS proposed a few years ago say that, okay, so for purposes of calculating the amount of depreciation that's subject to disallowance for entertainment use, you can elect straight line depreciation just for purposes of computing that disallowance. So, okay, that's good. You don't have to 100% of your bonus depreciation. Not all of it is subject to the percentage of personal use, loss limitation. But the good news is that, so if you take 100% depreciation in year one under the bonus, and you elect straight line depreciation for purposes of the entertainment disallowance, okay, you get some depreciation allowance disallowed in year one. But in subsequent years, if you're not taking any depreciation, the regulation says that the disallowance of depreciation deductions can't be more than what you actually took in depreciation. So this is kind of a nice thing that benefited a quirk in the regulations that and benefit of 100% depreciation. So you take you might have some personal use, entertainment use in year one and get some depreciation disallowed, but if you've got personal use in future years, your other aircraft expenses will be impacted by that personal entertainment use, but depreciation will not be impacted. So that's a nice benefit there. I was going to move on to section 179, unless there's any specific questions on bonus.
Yeah, we have one coming right now. On entertainment, if aircraft is on Part 135 for the purpose of in-house entertainment, it pays market charter rate, does this still apply?
So I think I understand the question to be that if instead of using the aircraft for entertainment flights, you chartered from the charter company for those entertainment flights, I think the IRS would say no, because the regulation for entertainment disallowance allows you to, it says you can only carve out charters and leases to third parties. So even though you might be chartering the aircraft, your own aircraft, through the charter company at fair market value charter rates, the IRS might not respect that. I don't know that they have a, I am skeptical that they have a basis for not accepting that, but I think that if they caught wind that that was going on, I think they would probably try to disallow it. It's not that people don't do that or don't try it, but based on the regulations that we've seen, I think it's clear that the IRS doesn't like that. So section 179, expensing. This is kind of redundant to bonus depreciation right now, because you don't, everybody's getting 100% bonus depreciation. So why would you try to elect Section 179 expensing when everybody's getting 100%? So 179 expensing allows you to write off in the first year, immediately expense instead of depreciate property placed in service. The Act permanently increases the 179 deduction to $1 million effective January 1st, 2018, not September 28th, 2017, like bonus depreciation. And like I said, the provision doesn't expire or sunset like the bonus depreciation provision does. So bonus depreciation 100% goes down to 80% in 2023, and likewise. But 179 expensing was made permanent. So whatever budget chicanery they had to engage in to get this thing passed, based on the price tag, they had to make some things temporary and they could make other things permanent. And they did that, but 179 was one of the things that was made permanent. So I think 179, unless I don't think there's going to be, at least in the aviation world, a lot of property that's going to be subject to 179, but not 168K bonus. I don't think 179 is going to make that much of a difference. Won't really come into play until 2023 or later. 179 does apply to new and used assets, just like bonus. The deduction phases out beginning at $2.5 million of property placed in service. You depreciate the remainder after you take the expense election, depreciate the remainder of the basis under makers. You can only take 179 if you have taxable income for that year. You can't carry it forward or back, under a loss. And like bonus depreciation, you got to remain eligible for makers, otherwise you get recapture. So here's a little chart that shows, based on the amount you placed in service, you get up to $1 million maximum 179 deduction, and then once you get to $2.5 million, the 179 deduction goes down dollar for dollar until you reach $3.5 million of property placed in service. So I don't think 179 is very relevant now, but it will become relevant in future years. I want to touch on the repeal of 1031 exchanges. 1031 tax-free or tax-deferred exchanges have been repealed for personal property. 1031 is still available for exchanges of real estate. This is effective as of January 1st, 2018. If you started a 1031 exchange before the end of 2017, if you either acquired the replacement property or relinquished or sold the relinquished property, you can still finish your 1031 exchange in the first part of this year. So that's good. From now until the end of 2022, your 100% bonus depreciation on your replacement aircraft will offset any recapture that you might have on your relinquished aircraft. So effectively, for 1031 exchanges under the 100% bonus depreciation rule. But beginning in 2023, as I mentioned, bonus depreciation goes down in chunks and then eventually disappears. So with the repeal of 1031, you're going to have to pay, if you decide to replace your aircraft, you're going to have to pay tax on the aircraft that you sold, and then you have to start all over again with your depreciation. So it's really a bad situation if we get to 6 or 7 years from now where we don't have a lot of bonus depreciation or it's gone to zero. Trading up into new aircraft is going to be expensive because we're going to have to pay recapture on the old aircraft and only get to depreciate a small portion of the new aircraft. So people say that they're going to try to get 1031 reintroduced or bonus depreciation made permanent. Again, more budgetary smoke and mirrors to get that passed. So there's going to have to be another tax bill, 5 or so years down the road to fix this part of it, or else it's not just aircraft that are going to be impacted. It's anybody that are going to be replacing or upgrading other types of business personal property. Getting down to the last couple slides here on some changes that the legislation made to entertainment allowance. They amended Section 274 to disallow deductions for entertainment trips, that had a business component to them. The proverbial ski trip to Aspen, to have a 4-hour seminar, but then everybody else went skiing the rest of the time. Expenses for those types of trips are gone. To the extent those relate to aircraft expenses, you've lost the depreciation for that kind of business entertainment use. The other more important thing, I think, is expenses for providing transportation to an employee to compute between their residence and their place of business are disallowed, period. So this could be very significant to companies that provide the perk of commuting on business aircraft to some of their high-level executives. So that's an important change to 274. With that, I think I've run through all the changes that are, majorly going to affect, directly impact business aviation. There are changes to corporate tax rates and deductibility of interest that, may shake out to have impacts on aircraft leasing companies and lease rates and that kind of thing, but it's still very early days. And I want to put our disclaimer up here. This isn't legal advice. We only give legal advice when we're engaged and we know your particular facts and circumstances. And again, we're 8 attorneys based in Bellevue, Newport Beach, and this is all we do. And if there are any other questions, Tom, let me know.
I will. We'll take a little breather here as we talk a little bit. This has been one of the best groups we've ever had for a webinar, and I think that's because Aero Law and its fine staff of attorneys are such superstars. I appreciate it. It's a great subject. There's the Aero Law's phone number is right there in front of you if you want to call and get your facts and circumstances. Engage these attorneys to get your exact questions answered. I had a little bit of a hard time sometimes determining what the actual question was, but from the time constraints, I apologize for that, but there's Nate's and John's phone number. And I really appreciate you, everyone, being on board. It appears that there are no more questions. So I'm going to end this presentation sometime within the next 48 hours. This entire presentation as a video will be available on our website, and everybody who signed into this event will get a copy of that link tomorrow. That's a question. I'm looking at the lady who takes care of that. Okay, so no later than tomorrow we'll have it all back. So thanks, Nate. Thanks, John, for being so noisy in the background there. That was a joke. Thank you all for attending, and let's do this again sometime. Thank you.
Thanks for having us, Tom. Appreciate it. Thanks to you all for attending.